Hi there, and welcome to the Surrogate Dad podcast. Welcome back to my second episode on the basics of investing. And so let's just go over the lawyer stuff first, just to remind you that I am just a dad giving out dad advice. I'm not a qualified investment advisor, and so none of this is investment advice. This is just dad advice. And so I just wanted to remind you of that before we get into today's episode. So with that said, let's carry on from where I left off in the previous episode. Today, I'm going to get into a little more detail, some ideas, some thoughts to think about for your investing. I guess, what you'd call a value investor. I don't buy a lot of stocks. I don't trade a lot of stocks. I generally try and buy good stocks that pay good dividends, that have a good chance of being around in 20 years, have a good chance of growing, just all around good companies. And, what does good companies mean? So we'll talk a bit more about that. So I don't have enough time to spend on regular detailed analysis of stocks, so I can't really speak in depth to technical investing, though I will give you a couple of little basic technical things you do need to know. Plus, the style of investing I use, we've done pretty well over the years without spending a lot of time and effort watching stocks, analyzing stocks. If it's something you really, really enjoy doing, knock yourself out. And I enjoy doing it, but I enjoy other things as well. So I don't have a lot of time for it. And one thing that's really helped me in recent years, and I suggest you do the same as soon as you can, find other like-minded people who you can bounce ideas off of, other people who are watching the market and invest similar to you, value investing style, if you're listening to Dad. If you're not, well, then listen to somebody else, I guess. So anyways, try and get people you can bounce ideas off of each other. I'm lucky my brother's more into this than I am, and it's really a one-way street. I get more benefit than he does. But you're going to want to try and get a group where you can get some and you can give into it some, and everybody pulls their weight, so to speak. But definitely find other people that share a similar mindset, but always be careful before you make any decisions. Okay, so again, what's called value investing is what I like to do. Buy good companies at good prices, hold them, and reap and reinvest dividends. Okay, so let's start with a couple of the technology or technical factors you need to know. Very, very basic. I'm going to go into it, just very simple stuff, but a couple of good things you might want to watch in a company. The first one, very, very common, called the price to earnings ratio, or PE ratio for short. And that is a ratio of the price of the stock over the earnings. So let's say a company is earning $2 per share every year, and the price of the shares to buy one share of this company is $20. Well, $20 divided by $2 is 10, so the price to earnings ratio is 10. The price is 10 times the earnings. So that's basically what a price to earnings ratio is, and you're going to want to learn we're talking net earnings, or what's often called EBITDA, or however they pronounce it, earnings before interest, tax, deductions, and amortization. So basically what you're looking at is the bottom line earnings after everything's deducted on a company. And if you sign online to an account with one of the discount brokerage houses, they'll have a lot of this stuff, and they'll show you PE ratio, they'll show you earnings and all that. So they make it a little easier for you. But that's one of the first ones to know. Now, price to earnings ratios vary by industry, vary by marketplace, by what kind of a market are we in. But I think, and I could be wrong, you can Google this, I think the long-term market average for, say, the New York Stock Exchange, Toronto Stock Exchange, may be different in other countries, is somewhere around 18 or 20 times or 21 times. It may have changed in recent years, but so that's an average overall for the marketplace. And so you can compare the price earnings ratio of a company to long-term averages. Another perhaps more accurate thing to do is you can compare the price earnings ratio of a company to the industry and some of the different discount stockbroker houses that have online accounts. Some of them will show you that. Here's the industry price to earnings ratio. Here's this company's price to earnings ratio. And you want to look for differences. If the industry is price earnings ratio is 10 and this particular stock is 15 or 20, then it's a really expensive stock. You're paying 15 or 20 times earnings to buy the stock, whereas the industry is only 10. First question is, why? Why is that? So you want to look into why it is. Could be a good thing. They could have rapidly rising earnings, and the earnings are going to catch up to the price. It just could be an overpriced stock. Maybe the stock is overpriced. These are things to look into. Anytime you see a variation, you ask why. And sometimes you'll see them underpriced. Oh, is this a good value? You want to check into that. Maybe this is a good deal. Or maybe the company's in real problems and you got to do a little digging to find them. So price to earnings ratio, not always that easy to just look at it and say, oh, this is a good deal or a bad deal. There's always factors behind it. Remember one thing, by the time industry news gets to people like you and I on the street, it's already factored into the price. 99% of the time, anytime you see a company that's overpriced or underpriced, whatever's causing that, all the people with all the knowledge, people that do this for a living every day, they probably knew about it a week ago or even a month ago. So there's usually something behind the scenes you need to dig out. And every now and then, there's not. And I'm going to talk about a couple of these opportunities when there's not something behind the scenes. So price to earnings ratio is one. Another one is debt to equity. How much a company is using debt to finance their growth and to finance their operations, and how much they're using investors' money, shareholders' money, their own money. So for example, let's say a company has a net worth of $500 million. And you find out that they have $250 million in debt and $250 million in equity. Equity meaning what we own. If you own, let's say you own a car, and the car is worth $20,000, but you owe $10,000 on it. If you sold it for $20,000 today, paid off your $10,000, you'd have $10,000 left. That's your equity. How much it's actually really worth in real dollars to you after you pay off all your debts. So let's say it's a $500 million company and it's got $250 million in debt and $250 million in equity. Then it's got a 1-to-1 debt to equity ratio. Let's say it's got, I don't know, I can't do the math that quickly, but let's say it's got $350 million in debt and 150, we'll say 330 million and 170 million, 330 million in debt and 170 million in equity. I hope that adds up to 500. Then it's got roughly a 2-to-1 debt to equity ratio. For every dollar of equity in the company, they've borrowed $2. Now, obviously, the higher the debt to equity ratio, the more risky, in all things being equal, the more risky it is because there's more debt. The less liquid the company is, liquid meaning how much cash do we have available, how much of our own money do we have available. And so the higher the debt to equity, the more risky. As a general rule of thumb, the less the debt to equity, the less risky as a rule of thumb. But then it could also mean if they don't have enough debt, they're not using debt properly. If you're wise and careful, you can use debt, and you should use debt wisely and properly to increase your rates of returns. That's a thing called leverage, and leverage is a double-edged sword. Leverage means borrowing money, borrowing as much as you can safely borrow. Some safely is a different term for everybody, but leverage is using borrowed money to increase your rate of return. I won't explain it in great detail here, but let me say that when you use borrowed money, you increase your rates of return, you get wealthier quicker. Woohoo! Well, if things turn bad, if the market turns bad, if something bad happens to your company, an unexpected surprise, and you don't have a lot of equity, but you got a lot of debt, you could go broke overnight. You could lose it all. So it's a double-edged sword. The more risk, the more debt you take, the more you increase your rate of return, generally speaking, but also the more you run a risk of getting into trouble and losing it all. So you've got to find that safe place for you. If you're not sure, err on the low side until you get it figured out. That's Dad's advice. All right. So there's a bit on price to equity, price to earnings ratio, debt to equity. I'll leave it at that for tech factors for right now. There's many more different things you can look into. And again, a lot of these online investing accounts, they'll have videos and different investor education videos that you can watch. So you can educate yourself on that. You can get into things where you start to watch the ups and downs of the market, and you get things like, it's called a double head and shoulders, I think it's called, and the line of level of support and level of resistance and all kinds of things. We won't go into that. I went to it briefly in the last episode into level of support, level of resistance, but I won't go into that because I'm just not really much of a technical investor. I'm more of a value investor. All right. I really like dividends, and I think I mentioned in the last session, here in Canada, if you buy Canadian companies, you can sign up for what's called a DRIP, a dividend reinvestment plan. And every time the company pays you dividends, it's automatically reinvested into the company. You don't have to pay any fee for that. Now, if you don't have enough shares and you don't get enough dividends to buy one share, they just throw it into cash. You have to have enough dividends to buy at least a share. But anyways, when you can, get into a dividend reinvestment plan for any stocks you can. If you can't manually, then every chance you get, take some of your cash and reinvest. Reinvesting dividends is a way of compounding your income. Okay, here's a couple of techniques. Buying good companies on bad news. A good example that I did many years ago was there was a company that's still around, great company called Maple Leaf Foods, and they had a situation where they weren't cleaning their equipment often enough, and they had a bit of an outbreak of a bacteria. And I'm watching it on the news, and they said on the news, they clean their machines every week. And my spouse, who is a manager in food service, highly trained in food service, goes, every week we clean ours every day. So I stopped and I thought, the only problem is they just need to clean their machines a little more often. This will pass. There's nothing wrong with the company. There's no major problem here. The share price of the company dropped a lot. Everyone's scared. I jumped in there and I bought a bunch, and sure enough, it went back up, and they're still going today, still a great company. So buying good companies on bad news. The question is, what's the bad news? And you have to make an educated guess. You got to look into it as best you can. Is this something that can be easily overcome? Might it be difficult to overcome? You want to be very, very careful about that, and you want to analyze it and decide your risk level with that. Okay, another thing, buy during market dips. When the market, every now and then the market not so much crashes, but takes a big dip. COVID. As you know, during COVID, the market crashed hard. Well, I look at it this way. Either this virus is going to kill us all, or it'll pass like every other virus and life will go on. So I'll tell you, I piled a ton of money into the stock market during COVID. And I followed, like I mentioned in the first episode, I followed my plan. I didn't just try and time the bottom of the market. I put a bunch in here. You can go back and watch the first episode over if you want to get a review of this, but at different times, as the stock market rode along the bottom, went down, bounced around, then came back up again, I was putting money into the market on several different occasions because I don't know when the exact bottom is going to be. Nobody knows that. So I kind of did a dollar cost averaging thing, which checked the last episode for that. But anyways, buy during market dips. If the whole stock market crashes, we're all going to go to hell anyways. So like I mentioned, if it crashes and everyone loses all their money, we got big problems. Now, of course, so if that's a concern to you, you always want to make sure until you understand this really, really well, don't ever get too much money into the market. I don't think it's going to crash to the point where we all the whole world's in trouble. But hey, it could happen. There's some crazy political stuff these days. So anyways, and if you're concerned about that, there are safe investments you can buy. There are safer things you can do with your money. saving certificates and that. But just remember, saving certificates may be really, really safe, but they're not good investments over the long term. So anyways, those are decisions you'll have to make. So buying during market dips, great way to increase your long-term return on investment. I sometimes I'll go a year, 2 years, maybe 3 years without buying any stocks. I sat on probably 25-30% cash in my account for a few years. But boy, when in our account, but when COVID hit, man, did I pile the money in. And well, take a look at how the stock market is doing since COVID. You'll figure out how that worked for us. Okay, new technology stocks and risk. And I think I mentioned this one in the last episode. But basically, new technology is the latest, greatest that's going to change the world. I'm really careful about those. I really want to be careful. New technology is a risky marketplace. The old story, this goes back before your time, but when VHS first came out, before CDs, we had movies on these big VHS tapes. And I remember I bought Beta. There was VHS and there was Beta. Before VHS and Beta, there was a time when audio, like songs, you wanted to buy an album of your famous artist. It was on a record, which is now coming back, records, great sound. But it went to cassettes. And there was a thing called 8-tracks as well. 8-tracks were huge, cassettes were small, so you could get a lot more cassettes in the same area, and cassettes were much better quality. So 8-tracks went out of business quickly, and cassettes lasted for many, many years. You could probably still get cassettes. So when VHS and Beta came along, Beta was smaller than VHS, and I thought, and the technology was, from what I read, was better technology. So I thought, I'm going to buy a Beta machine for our movies and buy Beta tapes. Well, as it turns out, the company that made VHS was a much bigger company than the company that made Beta, and they had much more money for a market war and market advertising. And so VHS won, not because it was the better technology, although it may have been, but it won because of marketing. So what I'm saying is, when it comes to technology stuff, especially new technology, you got to be really, really careful. There's a lot of dead bodies along the way. Many, many years ago, there was a company that made golf tees out of peat moss. If you're a golfer, you hit the golf ball and sometimes you break your tee. It's wood, it just lays there. It's a pain in the butt and they got to go clean them up. Well, their idea was to make golf tees out of peat moss, which is like fertilizer. And a friend of mine told me about this, and he said, he was one of the principals of the company. He told me about the idea, and I thought, what a great idea. Now, they had a couple things they had to get through first, and so it was risky, but a friend of mine and I, we both invested a very little bit of money together into it. And they passed they had a couple big tests they had to pass, I forget exactly, but they passed the first one with flying colors. The price went way up. I wanted to hang on. My buddy said, let's sell. So, you know what, you got to respect that when you invest together with somebody. So I respected it, and we sold our shares. He was right. We sold at the exact peak of the market. So we got lucky. Shortly after, they didn't pass the second test, and the company went out of business. So that would have been a bad decision on my part if he would have listened to me and we hung on. Luckily, we sold, and we just got the high of the market. So what I'm saying is, new technologies are always risky. So for me, I'm really, really careful about buying anything to do with technology. I really want to analyze that carefully. And if I do get into it, I don't want to put a big amount of money into it. Okay, so now I want to talk a bit about Warren Buffett style of investing. And I'm not a Warren Buffett expert. I don't know a lot about him. I only read this one book some years ago, The Warren Buffett Way by Robert Hagstrom. And it seems pretty good, and I'm going to read some of the stuff he talks about. And, there's a lot of good ideas in here, and I don't know if it's exactly the Warren Buffett way or not. It's a book I read, it's got some good ideas, and we'll see if it's... Anyways, here's some of the advice out of this book. First, so there's 4 different characteristics that allegedly Warren Buffett looks for or would look for. the business aspects of a company, the management aspects, the financial aspects, and the value aspects. He calls them tenets, but not everybody knows what tenet means. Kind of like means aspects, same kind of thing. So let's first start with the business aspects. And I'm not going to go in detail on this stuff because I'm not an expert, but here's just some good ideas. So here's the three things he looks for regarding the business itself. When you buy stocks in a company, you're essentially buying ownership of that company. You're buying a little piece of the ownership of that company. So he had three questions. Is the business simple and understandable? And I remember during the tech boom or after the tech boom, I remember Warren Buffett saying, I don't understand this stuff and I don't understand why they're worth these ridiculous values, so I'm not buying them. And he got ridiculed. And guess who was right? Warren Buffett was right. All these tech companies came crashing afterwards. So doesn't mean he's always right in all things and forever this is right. But anyways, is the business simple and understandable? Does the business have a consistent operating history? Does the business have favorable long-term prospects? Now, that's an interesting one. I bought shares of a Canadian company called Canadian Tire because I think, in my personal opinion, they have good long-term prospects. The things they sell are the kind of things we'll always need and the kind of things that just an online shopping company probably can't replace for the most part. For the most part, it's a long weekend, you want to do some work, you go to the store, you get the things you need, come home, you do the work. And so there's always going to be a brick and mortar presence for these kind of stores. So that's just one example. I'm not recommending, I can't make recommendations. I'm not an expert. I'm just giving you ideas and hopefully you'll use them to good effect. Okay, and so next are the management tenets or the management aspects. Is management rational? That's an important one. You don't want them irrational. Is management candid with its shareholders? How do they answer questions? How do they speak to the shareholders? And how much information do they give the shareholders? And does management resist the institutional imperative? With the institutional imperative, just basically meaning don't do like everybody else does. Don't just follow the herd, so to speak. Does management make decisions more wisely as opposed to just following the herd? Okay, so now let's look at their financial aspects of the company. So, do they focus on return on equity and not earnings per share? So earnings per share are if the company, remember I said earlier, this hypothetical company sold at $20 a share. And if their earnings are $2 per share, remember they're what did I say? $10, $20, I don't know. Let's say $20 per share and their earnings are $2. Remember the price to earnings ratio? 10 to 1, right? So sometimes they get focused on these short-term things that people just look at every day and people invest on sometimes short-term things. But a long-term good decision is return on equity. Of the money that we have invested in the company as shareholders, what's our return on that? That's a long-term sustainable good thing to do. Calculate owner earnings to get a true reflection of value. Now, it's been a while since I've been through the book, but if in any business, my understanding of owner earnings is there's financial accounting earnings, but there's also the realistic. Sometimes with financial accounting, we make different entries to meet accounting standards. And like for example, if you spend $100,000 on a roof for a building, well, that roof lasts 30 years. So we split that $100,000 expense over 30 years for accounting purposes. But we spent the $100,000 this year. So owner earnings are generally means this year, what did the owners earn? Let's just realistically, what do we put out? What do we get back? What did we earn? It's a little more complicated than that, and I'm certainly not the best person to explain it. So by all means, feel free to get the book or a similar book and read on this stuff so you get a really accurate picture. Okay, look for companies with high profit margins as opposed to low profit margins. That makes sense. Now remember, when you're looking at profit margins, it varies by industry. If you look at grocery companies, they traditionally have very low profit margins, but they're very steady in their earnings. People eat. Doesn't matter how the marketplace is, you got to eat. Doesn't matter how good or how bad the economy is, you got to eat at least a certain amount every year. You have to eat the same amount of food every year. So they have more steady earnings. So when you're looking at high earnings, you have to look at it in relation to the marketplace, in relation to their particular market segment, and different things like that. But those are the kind of the main things to look for. And for every dollar retained in the company, has the company created at least $1 of market value? Now that's an interesting one. That takes a lot of reading. It seems pretty straightforward. Have they created, for every dollar in the company, have they created $1 of market value? I'd have to go through it and read it all. I'll let you do that yourself. These are just guidelines from the book, and a few of them are certainly things I'd have to read over. I haven't heard that one for a while, so I'm not exactly sure what he means. It seems pretty obvious. Create $1 of market value for every dollar retained, but we'd have to go into more. I don't entirely understand exactly what the details are of that one, so I won't go into any more detail on that. So I'll stop talking now on that. And finally, investing guidelines. So when you're investing in a business, two things. Determine the value of the business. Don't be fooled. When somebody wants to sell something to you, a lot of people kind of fib a little on values. So whenever you're investing in a company, buying stocks, have a look at the balance sheet, have a look at the financials of the company, and try and analyze, try and read the annual statements. I know that's getting a little detailed, or maybe read what the analysts say. That'll save you a lot of work. Read reports on the company, but try and determine, is the stated value a realistic value? Sometimes a company has a stated value really high, but people are paying really low price for it. Either it's a great value or there's something there, somebody's fibbing about the value of the company. So these things are never that easy. So determine the value. So before you buy a stock, make sure you're paying it. Do your best to reasonably make sure it's a reasonable price. And buy only when the price is right, when the business is selling at a significant discount to its value. Now, of course, if you're Warren Buffett and you're buying a company and you're going to own that company, that's easy to do. I shouldn't say easy to do. It's never easy to do. Easier to do. I bought companies, and you'll probably buy companies, and a lot of people buy companies when you're in the stock market and you're only buying $1,000 worth or $100 or $5,000 or $10,000 of a company. Sometimes I'll pay, you know what, you're paying what it's worth. When you're investing online, you're paying, unless you're getting one of the deals I talked about earlier, but generally you're paying what it's worth. So I guess maybe a better thing is don't overpay. If you have the luxury of buying entire businesses, then you can analyze it like he does and always buy it at a value, which is what he does. But sometimes, a good company paying a good dividend with a good future, when you're buying in the stock market, you're paying what the market says it's worth today. So don't, how can I wrap this up? By all means, pay fair price if you think there's a good long-term prospect, there's good dividends, there's good growth prospects. Buy it. If you can get a great deal in a company, great, buy more. But don't hesitate. You got to get invested. If you wait too long for a great deal, you're going to miss out on a good enough deal. So that's a pretty vague way, but hopefully it makes a lot of sense. When you're buying in the stock market, you're kind of paying market value. Don't be afraid of that. By all means, if everything looks good for the future, pay market value. If a COVID comes along or a Maple Leaf Foods incident comes along, things like that, and you can get a deal, buy a deal. Absolutely. So there you go. I want to finish off with a little bit of a discussion on crypto. And I'm not an expert in crypto. And the best I can discern what crypto actually is it's an alternative currency for people who aren't entirely comfortable. Our currency is a good thing to hold. So maybe you think the governments are getting a little goofy, maybe they spend too much money and they devalue our currencies, which certainly does happen. That's something we'll maybe talk about in another episode, devaluation of currency and such. But crypto is more an alternative currency for people who feel that maybe our currency isn't safe, and so I'm going to go and get this other currency. Well, the question is crypto safe? And of course, the answer is nobody can answer that. You have to make your own judgment on that. I laughed at crypto. My brother's heavily invested in crypto. I laughed at him. He explained it to me. I'm now buying crypto. But I am being cautious with how much I put into it. But I am buying it, and it's been a good return. But anyways, I just want to have a bit of a discussion on crypto. Don't poo-poo it because your friends go, crypto, you're not one of them, you're this, that, whatever. Anything you invest in, just stick to the facts, stick to logic. Does this make sense? Don't ever take advice from anybody who look at that person and say, how have they done for themselves? Are they doing well? Or have they made great investment decisions in their life? Anytime you take advice from anyone, look at where it's coming from and analyze it. Is this good advice? How much work has this person done before they gave me this advice? And another thing with advice is, does this person have my best interests in heart? Are they totally unbiased in what they're saying? So be careful with advice from other people. I would encourage you to look into crypto. There's online, of course, lots of resources where you could research it. I don't know. I've got some money in it. Yeah, I guess I'll leave it at that. So there's our second section on investing. Just a final reminder, I'm not an investment advisor. This is not investment advice. This is dad advice. Dad giving you some ideas. Do your own homework, but get into the market. Get invested. Invest in whatever you're comfortable with, but get invested. I like to be on the lower risk side of things. We bought some great companies along the way and I believe, I haven't analyzed it in detail, but it looks like we've done really well, and I think we've outperformed the market, which is a hard thing to do. But by using these value investing principles, reinvesting dividends, buying good companies, buying during times like COVID, buying anytime the market takes a noticeable dip, buying some, using dollar cost averaging, using all these simple principles that you and I can use, you can do really well in your investing without taking big risks. And you don't have to be a technical investor. And a lot of these technical investors aren't really beating the market. I think I talked the last episode how most mutual fund managers, professionals, can't beat the market. Now, there's so many of them and there's so much money being managed by them, there's an argument that they are the market. So that's another argument. Anyways, I'm going to leave it at that for today. I'm going on a pilgrimage. I'm going to walk the Camino de Santiago. I leave tomorrow, which is probably last week or last month or last year when you see this video. But I'm leaving tomorrow, and so there may or may not be another episode in the next 6 weeks or 8 weeks. I'll try and do something on the road. If I think of some good dad advice for you, I'll try and see if I can do one on the road. But I'll be in Spain walking, so I may or may not get one to you in the next 6 weeks. I'll try my best. Remember, Dad loves you, and listen to your mother. Bye for now.